Steve Penny is a full-time trader and investor specializing in the silver, gold, and uranium markets. He has been following the silver market for decades. This is what he says.
Yeah, there are two books come to mind. The first one was a Peter Schiff book, and I think he does a really good job. You know, he's kind of divisive character these days, but he does a really good job explaining the macro fundamentals of how our debt-based fiat monetary system works. Then I read a book by G. Edward Griffin, and that just goes way down the rabbit hole. And at first you're like, well, this can't be true. And then the more research you do, you're like, this is actually how it works. And they don't teach you this in school. And from there I was hooked. And I've made a career out of it now.
Yeah. And so what were some of the shock factors that led you to keep on diving deeper? Like what were the realizations or what occurred?
Well, I guess, first of all, the idea that all currency is borrowed into existence and then it's owed back to a private bank based on the labor of everyday workers. And there's always more debt in the system than money available to repay it. I mean, that was just mind-blowing to me. And it's a perpetual wheel where the general populace is always working to repay interest on the debt to these private bankers. And that was just mind-blowing to me. I thought, this can't be true. And the more research I did, sure enough, that's a fact. And no one teaches that in school.
No one teaches that in school. And so your reaction to that was to, I'm speculating here, you tell me if I'm right or wrong, your reaction to that, this system doesn't make sense. Therefore, it's unsustainable, it's unsafe, right? That maybe drove you towards alternative asset classes outside of the monetary system, like gold and silver. Is that sort of what occurred?
That's exactly what happened. And I'll point out too, that I made a lot of mistakes. And I think a lot of people right now are waking up to how the world works and how the monetary system works. And it's easy for your initial reaction to be like, sell everything, go pile all into silver and gold. And that's what I did. And I had no timing models. I had no strategy. I just sold everything and piled into the metals. And I think that's going to work out fine in the long run, but there's a better way to do it. And the last 10 years have spent refining strategy and timing tools and things like that. I think the first thing you should decide is sit down and think about how much of your total personal assets do you want to even allocate to these sectors, to hard assets, to silver, gold. And then from there, then you can decide, I'm a big advocate for owning physical metal first. I say build your moat before your castle. I look at that as defense, part offense. And then decide, how much you want to allocate to mining stocks. And it doesn't have to be all, these penny stocks, these explorers and developers. There's a place for those, but I think a lot of new investors tend to overweight into those, not fully understanding the risks. I mean, a lot of these companies are one poor drill result or mining permit away from, a catastrophic decline. So, you need to understand the risks and have a strategy. Most new investors think about the potential reward, where if you talk to a savvy, veteran or a professional, they always think in terms of risk-adjusted return, where your average retail investor tends to think about just total potential return. And we need to think about risk-adjusted return. And, speaking about the different categories of stocks, like personally, I think the royalty companies offer the most favorable risk-reward ratio. They're probably not going to be 20 baggers, but downside risk is minimal. For me, I like to avoid consumer debt. In the beginning, I took out, I'm almost embarrassed to say this, but I'll be transparent. I use credit cards to buy physical metals and paying, interest on that. That's not a smart way to do it. So I like to say, get rid of consumer debt first, then decide, how much insurance you want. That's your physical metal before you start speculating in the mining stocks.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
You mentioned royalty companies as the best risk reward possibility. So any that stand out, Steve, that you think people should take a look at? Any favorites in the market yourself?
There's a few I like. I own 3 of them, but one that I really like right now, I'll mention is Sandstorm Gold. The chart looks very compelling on a long-term chart. And I think the fundamentals are very compelling. A lot of people are turned off because of their Hod Maiden project in Turkey. Turkey is a very unstable jurisdiction right now, but sure. I think that project is going to turn out okay. And if it does, it could really, you could see an upward revaluation of that stock pretty quickly. So Sandstorm is one I'll mention. So, my personal strategy, acquire physical metal first, then the royalty streaming companies, and work down the risk curve. That's how I like to do it and how I like to coach people to do it. So senior producers, and then work your way down to the explorers and developers. For me, 20% of my portfolio is what I'm comfortable with. I like that in the high risk explorers and developers, because not having a nice basket of those, if they hit, 20% is going to quickly become 50, 60, 70% of the portfolio.
Yeah.
And I'm comfortable with that. And I'll throw out one more strategy with those too. As the bull market matures, I like to call it de-risking the portfolio as the bull market matures. So anytime you're up 200, 300, 400% on one of these high risk plays, something I like to do is put a trailing stop just to get my initial capital off the table. Mm-hmm. When that stop triggers, then cycle it back into the safer plays like a royalty play or even physical. And that way you're still having exposure to the sector without, while still taking some chips off the table. Mm-hmm. And ensuring you don't give it all back. It's much harder to push the sell button than the buy button. I like to say, whenever you do push that buy button, have a subsequent plan ahead of time for when you're going to push the sell button or take some off the table. Because doing it in the heat of battle, or when stocks going vertical, it's going to be really hard to make decisions in the moment. So having a plan is key. Personally, like I said, once I'm up roughly 200 to 300%, I'll put a trailing stop to get my initial capital off the table. So that's one kind of rule or strategy you might consider. Another one, let's see. For losses, this is key for my strategy. I don't use stop losses on my long-term portfolio, but I take 10% of my overall portfolio and I put it into a dedicated trading account. And whenever I'm buying or selling in the trading account, I always use a stop loss. And I never want to lose more than 2% of my trading capital. So that's how I set my stop. So that if the whole sector moves against me, my whole trading account, that 10% turns to cash, and that's the cash I have to scoop up bargains. So I don't use stops in my long-term portfolio to protect downside risk, but I've got that dedicated trading account that becomes a cash account in the event of a sell-off. Yeah, and I'm not one. I'm always reluctant to put out predictions, but I do want to have some ultimate targets. And the way I came up with those is just averaging previous bull markets. So it's not like I'm just pulling this out of my, just throwing numbers out there.
Yeah.
So the $15,000 gold is just an average of the previous two bull markets, the 70s bull market and the 99 to 2011 bull market. And I believe that was about a 15x return if you average those two. And if you consider the start of this bull market in December of 2015, that was, I believe, gold bottomed at $1,045 in December. So 15x gives you $15,000. And the average duration of those bull markets was about 10 years. So that gives you right into early 2026. Now, is it going to unfold exactly like that? Highly unlikely. But it does give us a roadmap based on historical precedent of what's possible. And, that can prevent me from taking all my chips off the table if gold goes to 2,000 or 3,000, because I think we'll still have a long way to go in the coming years. And it's going to be a wild ride. And then I did the same thing with silver and platinum and uranium.
Small ebook, big impact, the wealth tree. The only 4 ways that will make you financially free forever. Download it here for free.